Hello and welcome. Today, we're diving into the story of one single, powerful number, a real hero in the investing world. We're talking about the famous, and yeah, sometimes infamous, price-to-earnings ratio. Let's get right into it. This is the big question, right? It's the ultimate treasure hunt for any investor. How do you actually sift through thousands and thousands of companies to find that one hidden gem, the stock that everyone else has overlooked, the one that's truly a bargain? For the longest time, the answer seemed to be this one. Simple, elegant number. The PE ratio was the go-to, the shortcut, the hero that promised to show you a stock's real value in a single glance. But, as we're about to find out, even heroes have their flaws. So, let's start with the promise. What is this tool actually supposed to do? What's the big idea behind it?
Okay, here's the official definition. You take the company's current stock price and you divide it by its earnings per share. What you get is basically a multiplier. Think of it like this. It tells you how many dollars you have to shell out just to buy $1 of that company's profits for a year. Sounds pretty straightforward, doesn't it? And that simple math leads to this classic conventional wisdom. A low PE could mean a stock is cheap, a bargain just waiting for you to scoop it up. A high PE, on the other hand, might suggest it's expensive, maybe even overvalued. This is the core promise, a quick and dirty gut check on whether a stock is a deal or not.
But of course, it's not quite that simple. To get any real value out of this number, there are two cardinal rules you absolutely have to follow. Okay, rule number one, you gotta look backward. Compare the company's PE today to its own history. Is a PE of, say, 20 high or low for this particular company? Then, rule number two, you have to look sideways. Compare it to its direct competition. A PE that looks insane for a boring old utility company might be totally normal for a super fast-growing tech firm. Context, as they say, is everything.
And wow, this chart just drives that point home perfectly. Just look at this data from November 2025. The average PE for a tech company is almost 34. For a utility, it's less than 18. And for telecom, it's down around 14. You just can't compare these apples to oranges. You have to compare them to their own kind.
Now here's where our hero's story starts to get a little complicated. Sometimes a stock has a low PE for a very, very good reason. The company's in trouble. This is the classic value trap. It looks cheap on the surface, but it's really just a cheap ticket on a sinking ship. And this is our first big clue that maybe, just maybe, this one number doesn't tell the whole story. Which brings us to the next chapter in our journey. It's time to talk about when our hero, when the PE ratio flat out lies to us. One of the biggest issues is the E for earnings. You see, companies have to report their earnings based on official accounting rules. That's called GAAP. But they also like to report their own version, called Non-GAAP or adjusted earnings. And as this quote makes clear, those adjustments can conveniently leave out some pretty big costs, which, surprise, surprise, makes their profits look a whole lot better than they actually are.
But here's what's so fascinating. Financial research shows there's a real trade-off here. On one hand, these non-GAAP numbers, the ones the company wants you to focus on, are often smoother and actually better at predicting future profits. But the catch? They're way less conservative, and they're much slower to show you when things are going wrong. So the question for you, the investor, is which story do you want to believe?
And there's another massive blind spot, especially in today's economy. The PE is all about current earnings. That means it completely misses the boat on incredibly valuable things like a killer brand, priceless patents, or the power of a giant social network. A lot of the time, those are the very things that make a modern company so valuable in the first place.
So this is the point in the story where our hero realizes they can't save the day alone. The PE ratio needs a partner, a sidekick, to help cover its blind spots and paint a much more complete picture.
And that sidekick's name is EBITDA. I know. It's a mouthful. It stands for earnings before interest, taxes, depreciation, and amortization. But the goal is actually super simple. It's designed to measure the raw cash-generating power of the business itself, before all the clever accounting and tax stuff gets in the way. Now, when you take EBITDA and you pair it with something called enterprise value, which is the total value of a company, including its debt, you get a new, much more powerful ratio, EV to EBITDA. And this is PE's trusty partner. Look at the comparison. Where PE gets all twisted up by accounting tricks and debt, EV to EBITDA cuts right through it. It lets you really compare the core engine of two different businesses, which is a much cleaner, more honest comparison.
So what's the big lesson from our hero's journey?
It's that you can't just rely on one hero, one number, to give you all the answers. A smart investor needs a full toolkit.
So let's nail down the key takeaways. First, use the PE ratio, but only as a starting point, never ever as the final word. Second, always question the E. Know if you're looking at real earnings or the adjusted sunnier version. Third, go beyond PE. Bring in partners like EBITDA to see the whole picture. And last but not least, remember context is king. Always compare a stock to its past and to its peers.
And that really leaves us with this final thought to chew on. The goal isn't to find one perfect number that tells you everything. The real skill is learning how to listen to the story that all the different numbers are telling you, together, because that's where the true insights are found.